last 6-7 years, the rise of capital expenditures related to power and associated natural resources, if artificial intelligence has just been staggering. If you have a waste to value commodity converter facility, you've got a pretty good foundation of a business that can scale. We will share this industry, not dominate it in the future, given where we are right now.
Hey everyone, quick note for you. You're currently listening to the free preview of this episode. If you'd like the full thing, the full shebang, go over to our Substack. That's cleantechies.substack.com/subscribe and become a paid subscriber. Any paid subscription gets you full access to the show on the Clean Techies Substack. Hey everybody, welcome back to Clean Techies, the #1 podcast for climate tech entrepreneurs. Today we are talking about critical minerals with Nick Rohleder from Climate Commodities. Nick has actually been on the podcast in the past. That's episode 61. Check it out. A lot of it is, there's a lot of stuff that's relevant to what he does, but some of the kind of topical issues at the time are going to be a little bit irrelevant because it was, something like 3 years ago. But given his deep knowledge of the critical mineral space as an investor and an entrepreneur in the space, we wanted to unpack kind of the landscape of critical minerals, as it's a really big discussion right now with this whole idea of onshoring mineral production and refinement in the U.S. as we're kind of going into this Cold War with China, or I guess you could say escalating this Cold War with China. So this is kind of the first half of the discussion, is really what is the landscape of critical minerals? What are the core minerals to be aware of? Where do they come from? Who refines them right now? And what is the U.S. lacking in regard to that whole area? Like, where are the areas of opportunity there? And he also did give us, as part of that, kind of a little bit of a history of the U.S.'s rise and fall with how it relates to like metals and minerals and everything like that. So that's kind of the first half, is just the landscape. Where's the demand coming from? Who controls the demand right now? And where are the areas that we really need to invest in for the U.S. specifically? He mentions a few other countries, but I would say we largely focused on the U.S. In the second half of the conversation, that's when we kind of go deep into all of the opportunities for entrepreneurs. Anybody who wants to build a company in this space, whether that's in any part of this value chain, he talks about what needs to be present if you're going to succeed in that space. And I think it's pretty relevant because he does invest in these types of companies. He said, here's the things that we need to see in order to make it make sense for us to make an investment. There's a couple core components to success in this space. And I would say that's kind of like largely the second half. I will say that second half of the discussion is pretty much all behind a paywall. So if you're not already a paid subscriber, this might be the time to upgrade to paid to be able to get access to that part of the discussion, as well as all of our episodes that we put out. You get access to all of our content if you're a paid subscriber, and access to our group chat. So if you're interested, sign up today to become a paid subscriber. But other than that, thank you so much for tuning in again today, and let's get into the episode. All right. Welcome back to the show, Nick. How you doing?
I'm well. Thank you for having me.
Yeah, I'm very excited to have you back. For people who have not listened, you've been on in the past. I actually have to figure out which episode it is and reference it. But before we get started, I guess give everybody who's not heard you before a little bit of a TLDR on kind of what you do and let's say why people should trust you on the subject.
Yeah, happy to give my full background here, and thank you again for having me. So my exposure to commodities and natural resources really started at the dinner table as a kid. So I grew up in Tulsa, Oklahoma, in a family that was involved in the oil and gas and metals and mining industry. So specifically the midstream and downstream oil and gas sector and the coal mining sector, and some associated other minerals in that same basket as well. And so I worked construction jobs across these varying industries, everything you don't want to do when you're a kid growing up in Oklahoma to learn this business, but then caught the bug for alternative energy and climate and went to school for it. So I attended Columbia University, UPenn, and Oxford University, focused on finance and project management, and really got some good deep experience as to, if you think about natural resources and commodities, how you go from the cost curve to perhaps volatile jurisdiction to understanding how to style, finance, and implement a large-scale project across clean power, clean fuels, midstream metals and mining, and then traditional energy, oil and gas. And so over the last 5 years or so, I've had Climate Commodities, which is myself and a partner's company. So what we do, we provide early stage capital and infrastructure to companies addressing the build, not technology portion of the sector, backing up into the energy transition artificial intelligence and defense demand for electricity and resources in the form of molecules and in the form of critical minerals and materials. And so that's our model. And really what we believe is that there is a capital market for technology in a lot of these areas. But if you really look at where we have to go now to meet some of these targets, whether they be net zero related or security related at this juncture, a lot of stuff has to get built. And it has to get built with third party project finance / institutional capital. And so that's really what we focus on, is that bridge from inception through project finance. And so that's my day job. Outside of that, I serve as a fellow at the U.S. National Security Institute, focused on critical minerals and materials and other related security issues. And I teach finance and commodities courses at UPenn as an adjunct professor. So that is myself in a nutshell.
Yeah, definitely a nice resume there, man. I think it's good to have you on. I think you've definitely got some insight in this space. And again, my curiosity could ask you a bunch of questions for some of those things, but we're going to stay focused on the topic of critical minerals today. So that's what we're here to talk about, is just really kind of breaking down a little bit of the critical mineral space, because it's become a pretty hot topic with Trump taking office and people kind of putting some focus on the national security angle of this. So before we get into things here, give us a bit of a history, like a brief history of the U.S. mineral production kind of space in general. How we were leader at one point and not so much anymore.
Well, it's rather interesting. So if you go back, 75, 80, 90 years, there's a much different landscape in play. As most people know, the US effectively had a monopoly on heavy manufacturing and the associated supply chain from the turn of the 20th century until about 1960, 1970, when this started to change. And so around the Second World War period, and the period we kind of tying that into where we are now, where there's a heightened focus on defense minerals in particular, as you have a renewed instability situation in the Middle East, the situation with Taiwan and China, and then war in Europe with the Russia-Ukraine situation. And so we were acutely aware of how critical minerals and materials specifically relate to maintaining defense and deterrence capabilities around the Second World War period, and then closely thereafter at the onset of the Cold War. And those tensions really being developed fully leading into the Cuban Missile Crisis, and so on and so forth, until the fall of the Iron Curtain. And so over that period of time, and really in the mid 1960s, you have the peak of this, right? In the 1970s, you have Iran-Contra, you have the focus on coal, and you have a situation where the U.S. starts to regulate these companies on an environmental basis. And so the start of this is really the cost of U.S. labor increasing, the cost of doing business in the U.S. increasing, and then environmental regulation and associated regulation coming to this sector for the first time in sophistication and at scale. And so that happens. And then in the 1980s, China starts making strategic state-backed investments in the metals and mining value chain. And at that period of time, with less automation we have now and a much lower cost workforce available at scale and organized. And so these dynamics really led to the start of offshoring, and which was subsequently accelerated by, everyone reads about the 1980s, capital markets, Wall Street, that kind of the golden era there. But what is not talked about enough in that is that, the focus on margin expansion and offshoring and, growth at any cost us a lot of our domestic industry. And so, fast forward to now, we have seeded that industry entirely, and we've also seeded the institutions, whether they be technical schools or universities as well. And so not only do we not do this, we now are lacking in human capital and, most importantly, process knowledge in these critical areas that are becoming increasingly important with the global situation and security circumstances deteriorating, and are now reliant on, if you take China, for example, as an adversary, given the rhetoric of the current U.S. administration, foreign and or adversarial process knowledge to achieve our aims in self-sufficiency. And so this is really kind of how we got here. And a lot of this, if you go from the 90s forward as the last point, at the peak of the global American unipolarity, we got rather complacent in this area specifically. And we're now trying to rapidly figure out how to backtrack regain relevancy and really focus on self-sufficiency, because we've seeded this to a point where we will share this industry, not dominate it in the future, given where we are right now.
You know that feeling when you meet someone who shares your vision for the future? It just clicks, like two peas in a pod. Well, that's exactly how we felt when we met Goodwin, who we are proud to have as our sponsor.
Being the first major law firm to set up a climate-specific startup and venture practice makes them exactly the kind of partner we are excited to work with. They realize that there are a plethora of challenges to building climate tech startups, and that's why they have built an entire suite of resources for founders, investors, and entrepreneurs in the space. They even offer several tailored pricing methods. And guess what? It doesn't matter where you are listening to this. Goodwin is a global law firm that you can trust to be your partner through it all, from incorporation to exit. They've got you covered.
Go to goodwinlaw.com and tell them Clean Techie sent you to get exclusive access to startup resources. All right, back to the show.
So would you say that, just broadly speaking, like all of the talent that knows how to do this stuff, not kind of setting aside the difficulties with environmental regulations, the talent is not really coming out of the US to do this stuff, or if it's here, it's like pretty old people who are retired?
Well, it's people. It's interesting because some of the industries that we're active in are utilities, metals and mining, where there tends to be a lot of gray hair, and there's really a dearth of young people. And I think specifically to metals and mining, there's a resurgence occurring, but there is not a lot of process knowledge to draw on from which to accelerate that resurgence. And so you have institutions like the Colorado School of Mines that just focus on this. Many of the top universities in the United States are starting to think about, we have a climate school, a climate program. Where does metals and mining and supply chain fit into that? And starting to build out some of this infrastructure. But they're coming from a point where a lot of this is theoretical and partially applicational, where if you go to China in a similar program, you could have modules and modules and modules of, go visit an active processing facility or refining facility and really understand like that iterative process knowledge that is required really to drive innovation. Same thing, access to raw materials in abundancy and cheap. We don't have a lot of these things. You look at, the foundation of a lot of innovation, especially from an academic perspective, is cheap and abundant access to raw materials. And we don't really have that. So we're starting from the ground up. And I would say the vast majority of human capital that is available on a turnkey basis now to execute on these initiatives is foreign. Historically, there was a large, in the colonial era, a lot of the European universities did build programs and competencies to send people to these jurisdictions to effectuate mining related business activity. But that has declined too. And so I think that, it really is an existential issue, because we're talking about, we have to have domestic suppliers, domestic everything, but we don't have the people. It's coming back, but it's a long way to go.
Yeah, so I'll just try to like re-summarize this to the TLDR is basically the U.S. used to be a leader in this space of extraction and processing of minerals, broadly speaking, and metals. And then over time, it went overseas, partially because we had this kind of love of like, let's bolster China, let's help them come out of poverty to an extent. And then eventually Wall Street was like, hey, we can make a lot more money if we produce these things cheaply overseas. And now we're getting to a point where, after a bit of complacency, not as many people are interested in the space. We don't have that many people going into the schools, at least. They've probably been enamored by technology broadly in the 2000s, et cetera. And now we're at a point where we realize, oh shit, like we kind of need we need to produce some of these things locally if we want to be secure from a national security perspective. Is that accurate kind of summary?
Absolutely. And I think that, the last thing to point out there is that, it's not all doom and gloom. There is a ton of opportunity for talented young people in this space, because it has to be completely rebuilt. The issue there is that, it is properly entrepreneurial. And on the on the other side of that too, the capital market for this industry is also going through a lot of changes as well. And so it's not just the human capital market for this, it's also the capital market that is changing and evolving and trying to figure out how to serve the West as it seeks self-sufficiency for defense and net zero purposes.
So one sidebar, we didn't necessarily plan to talk about this, but I think it's important to bring it up right now, would be if the capital markets are focused on just kind of like pure efficiency, like is there a way that they can be, aside from like altruistic methods or ideas, is there a way that you can get them to still focus on investing in U.S. projects, even if the cost is going to be higher and the tech, hypothetically the rate of return is not going to be as high?
Well, I think what I would say in with respect to the capital market in metals and mining is that for a long time, China has dominated a lot of these industries, sub-industries, so to say, to the tune of 60, 70, 80+% from mining, where they're doing it domestically or they've made a control investment overseas, and then processing and refining. And so what I would say there is that this at a base level, we're going through the formulation of a functioning equity and debt market for metals and mining outside of China and outside of seemingly volatile jurisdictions, to where the only investor was China historically. And so you think about some of the areas that are rich in deposits of critical minerals. You look at the Belt and Road Initiative and other things such as that. The Chinese do take a fair amount of jurisdiction risk that Western investors have not. And I think that you see, we're in the early days of figuring out how we do that. You look at the libido corridor in Africa terminating in Angola. It's U.S. led. Like, there are things such as this, so we're starting to rediscover. Okay, how do we really do business at scale with natural resources in some of these markets? Whereas, like, if you look at now and you think about where is the U.S. doing business from an international perspective, it's pretty easy to reference. I mean, look at Netflix's subscriber growth. India is the biggest market, right? And so our emerging markets lens has been, how do we get the cost-effective subscription to take off in a developing country, the emerging market? And I think we have to reframe it to, we're an interconnected world from a natural resource perspective. How do we develop a capital market that is ex-China, that is compliant with global trading regulations and frameworks, that allows us to achieve that, while also maintaining an active private investment community that is making money, is thriving? Because that just hasn't been given thought in so long.
Climate tech founders are taking on a huge challenge. Not only do they need to know how to build a startup, but they also need to deal with hardware, have a strong handle on climate policy, know how to fundraise from diverse investor types. It's a lot.
That's why we made Clean Techies, the #1 podcast for climate tech entrepreneurs. In addition to our jobs, we devote 20 hours a week to producing this podcast for you. This way you can learn from the people who have walked the path before you, learn from their mistakes, and gain insights on navigating this complex journey. If this mission resonates with you, we are asking for your help. It takes a lot of effort and it's not free.
If you are already a subscriber and want to help, start supporting us today by going to Substack and clicking Upgrade to Paid. Thanks for helping all the climate tech entrepreneurs like you. Yeah. So, okay, this makes sense. So I guess the next thing is, where is the current demand for minerals coming from? Like, what sectors are really pushing this?
Well, there are really three areas. If you think about this space and what's changed, right? A lot of these minerals that have historically serviced a sleepy industrial value chain that we'll talk about here in a bit are experiencing whole new demand centers that are emerging, and then emerging at scale with huge demand pressures behind them. And so you think about that, energy transition for a lot of these is the biggest opportunity and the largest focus area. And given the last 5-6 years with electric vehicles and ancillary things as solar panels, wind, so on and so forth, despite the regulatory situation in the US, there's been huge growth. And so energy transition being one. Thinking about, at a base level, just taking electric vehicles, an electric vehicle uses 6 times more minerals than an equivalent industrial internal combustion engine vehicle. And so that's one. 2 is defense. We've just come out of one of the longest peacetime periods in history in the US and Western Europe broadly. We've had conflict returned to Europe. We've had conflict returned to the Middle East. And we have the largest peacetime military buildup executed by the Chinese over the last 20 years. And now rhetoric of the compromising Taiwan as an independent jurisdiction. And so what you're really seeing now is the entire world is waking up to, there is a security issue that is in play, and the circumstances in the regions that I've just mentioned are deteriorating rapidly in the eyes of some in the national security apparatus of the West. And so you see renewed sensitivity to what critical minerals and materials do we need self-sufficiency in to maintain defense capabilities in the event of a long-term conflict, and also for deterrence. And so to give you an example, you look at World War One and the British Empire at the time as the preeminent global power. They had the Boer War in South Africa in the early 1900s, and then 12 years later, World War One, and they fired more shells in the first 2 weeks of World War One than the entire Boer War. And so you look at the material demand of a real sustained conflict between superpowers is far different than that of regional proxy wars in which the U.S. has been engaged in along with its allies for quite some time versus an all-out conflict. And so making that distinction and the importance of minerals and materials there. Shifting to the last piece, in increasingly important here, the last 6-7 years, the rise of capital expenditures related to power and associated natural resources for artificial intelligence has been staggering. You see even in the last few weeks, 50, 60, 70 billion dollars of capital expenditures per each of these major technology companies. And so, the mineral demand associated with that is significant. And you have really a mega trend that if you just think about the growth opportunity and think about how much you use things like ChatGPT, how much I use things like ChatGPT, like that compute takes the power and mineral resources that will only grow over time as this is adopted. And I really do believe that this is one of the, apart from the internet, one of the biggest things that's going to change our lives over the next 2 years, 5 years, 10, 15 years. And so you have these three things converging that are creating a return, like back to the future scenario of where we were on the eve of World War II from a mineral security perspective, not only for defense purposes, but for net zero, the planet, and also maintaining domestic industry, where I think that, looking at back then, steel was the ultimate, okay, we have, you talk about steel is the backbone of our American economy. It's the backbone of defense. And I think that now you translate that to mineral security leading to industry security. I think AI is the backbone of military and economic capabilities, given the rhetoric that's been out, and also just thinking about how much technology has transformed modern warfare. That intersection there has to be made. As AI leadership is defense leadership.
So they're really closely connected. Got it. Okay.
Absolutely.
Yeah. Okay. So then walk us through, let's say, the top, I don't know what, 3 or 4 most important minerals that we will need to produce in order to meet this demand. Again, keeping this in the lens of the fact that there's entrepreneurs out there who want to build in the space.
Well, I think there's really a few things that they have to think about when you're looking at, so whether you're an investor or an entrepreneur. It's important that you focus on what problem are we solving, and then you pick the right submarket that lends itself to the capital and the personnel that you need to reach a successful outcome. Just looking at purely business and investment construct. And so, there's a couple things in play. Some of these minerals are energy transition pure play minerals. Some are defense pure play. Some are technology pure play, and some are a mix thereof, right? And so just kind of profiling a few, you look at the something like nickel, taking an energy transition via pure play with some industrial exposure, and really looking at, okay, so like if I'm going to create a business around something like this, and this is part of the issue with companies in this space, like you have to set yourself up organizational design day one, knowing you have to build stuff. And so that means that you have to think about and so I think that when you look at from a business or an investment perspective, you got to think about, okay, so how big is this market? What is demand center that I am really backing up into? And then if I had to explain to someone, think about meticulously downside focus, right? As someone, how does this actual market work? How much data is there available? Taking this commodity in particular, you do have that liquid market, right? And that is increasingly important, especially if you need banks, right? Or you need like traditional capital markets players to partner with you. That's a really important piece. And so that's nickel, right? Shifting to something that is more pure play defense, like tungsten, right? That's a $3.5 billion market. The main defense application there that people cite is ammunition. China is about 80% of that market. The liquidity in that market is very low. These are bilateral contracts, party to party, and the issue there is that you're really reliant from an in-market perspective on defense and government-related contracts, which, depending upon the jurisdiction that you're working with, can be somewhat challenging. I mean, people in this industry and all the way down through construction, contracting, and then on the investor side, it's plugging into that ecosystem, making sure you're entrenched in it to provide that de-risking to your investors and help to your founders. Shifting to a technology pure play, looking at gallium. So China is 98% of this market. This is a good example of a hypercritical pure play commodity used primarily in the semiconductor and computing industries. It's a $200 million market. No transparency on the liquidity side of the end market, direct contracts, and really a proper esoteric commodity, right? And so you think about something like this in market, this is largely an unattractive area to be building a business or focusing on investment. It's hypercritical, but it's not at scale. And this is really where public policy meets private industry. And this is more of a government related issue given the size. And so the ability to recognize that as a business or an investor is really important. Going to kind of our list here of screening these commodities and trying to think about how do you build a business around it, and when do you recognize something that is a public sector issue where private support will need to be garnered from a process knowledge perspective, right? Looking at we'll do two others here, and we'll stop the lesson on commodities. But having a look at fluorspar, I think is quite interesting. It's used in the semiconductor industry, in lithium-ion battery electrolytes, and in traditional industries like steel and aluminum and ceramics. And so this is about a $3 billion market. It's 60% controlled by China. Market liquidity is medium but manageable, and it works on direct medium to long-term contracts. And so, this is an area where you kind of have an intersection of, you've got some pure play technology demand, you've got some pure play energy transition demand, and there are a series of niche applications where this is relevant to defense as well. And so you get kind of that, like, what we really try to look for. And I think if I'm a founder, I'm an investor, I'm looking for the intersection of these three megatrends on one of these commodities, right? So I can get a handle on, okay, like, I understand the macro, and then I can back into the contracting structure, and the market liquidity lends itself pretty well to a project finance type of structure if I need to scale and build infrastructure over and over again. And my downside risk from a adversarial actor market concentration such as China in this construct is manageable, unlike some of the previous commodities I mentioned where you have 90% plus concentration. If they decide to reset that price, there's not a functioning global market outside of that to suggest an alternate price deck. And so the downside there without serious government intervention is very severe. And so those are, the last one here really being lithium. Going into another pure play energy transition commodity that's a little bit more straightforward than nickel, between $25 and $30 billion market, depending upon the outlet that you derive your data from. Primarily resources produce. This is interesting, actually. Reserves are in Australia, Chile, Argentina, but the processing and refining is largely concentrated in China. So you have a solvable supply chain issue in play, and then you have an end contract that is listed. There is transparency. The depth of liquidity is not where it needs to be, but it's actively improving, and you have a very active OEM in market and increasingly active trader in market to support bankable contracts. And so friendly jurisdictions, increasing liquidity, and well developed the downside case scenario in the event that the infrastructure that's built ex-China for processing and refining continues to be built. And so I hope this is a helpful kind of framing of different commodities, the various demand centers in this area, and kind of how to think about building a business. Because the big thing, I think, and we can go into this after this, when you're building a business, like you have to set up day one to assume you're going to have to build stuff and access project finance, which most technology-centric entrepreneurs and investors who don't think about that in the level of detail they should.
Yeah, so let me just kind of recap a couple of these things, and we're going to go into this a little bit deeper. So broadly speaking, the demand is in the energy transition, which you talked about. That's like one of the big trends. The demand is going to be for nickel primarily and other things, but nickel is a big one. In the defense space, it's going to be tungsten and technology broadly, AI, et cetera, for chips and everything. Gallium, and then there's kind of multi-demand inside of with needing fluorspar for multiple things, and then obviously lithium again for some of the other spaces broadly because there's a lot of electrification going on. So I've got that correct.
I think this is broadly a good sampling of a suite of commodities that are in play with this dynamic to varying different degrees, and the business realities of investing or building in any of these value chains.
Okay, so with each of these areas, like as kind of an entrepreneurial person and an investor, where do you see opportunities to build startups in that value chain? Is it actually going and finding ways to extract? Is it finding ways to recycle existing value chains or upcycle existing value chains? Like, where do you see the big opportunities for startups, both on the more, let's say, technology side of things and the actual maybe processing and heavy infrastructure side of things?
Well, I think that, I like to focus on the waste to value angle here, because I think this is something that is underappreciated, right? You look, let's just take the oil and gas industry going back here. So if we rewind 25 years pre-shale, we have an oil and gas industry that is going to the depths of the earth to serve modern demand for natural resources, right? And so you look at what was happening then: less high quality discoveries, more volatile jurisdictions, more uncertainty as to where we were going to get that commodity over the medium and long term. And so, we were in a rather precarious dynamic up until the mid to late 2000s when shale entered. You remember during the George W. Bush years, we were doing everything we could. And part of the interest in the Middle East by the country was oil. And you look at that too. You had, before Obama was president, standing up in, I believe it was a joint session, saying, in reference to the ethanol industry, we have our own food here, we can also make fuel out of it. Why don't we use that for energy security? And boy, how that's changed, right? We had shale, we had, the U.S. becomes a global swing producer of oil and gas. We have abundant natural resources, and this changed dramatically. And so we had, one event that really changed the trajectory of the oil and natural gas sector. And I think that translating that to metals and mining, the same dynamics are at play. We have less high quality discoveries, the less frequency of discovery, more volatile jurisdictions. And so, we believe, and I believe, that the waste to critical mineral value pathways are shale in this industry, right? And I think that what you're going to see happen over the next 3, 5, 10 years is people are going to realize, there's an existing consumption ecosystem for a variety of end products that have these commodities within them. Looking at semiconductor manufacturing and some of the waste streams associated with it, fertilizer, oil and gas, refining, the list goes on, of where these minerals enter our lives and then are discarded in landfills. And I think that the recycling technology ecosystem is starting to gain enough focus to where this waste to critical resource pathway is being taken seriously, and some of these technologies are being de-risked to a point where they can start to be deployed at scale. And there is a readily available ecosystem for waste to value, say technology, performance insurance, and other mechanisms that help you de-risk your business. And the most important thing is that we talked a lot a second ago around esoteric commodities, right? So you produce something, there's not a ready market for it. It's hard to explain to an investor in 30 seconds the downside. Whereas, if you enter into a circumstance where you have a facility that is taking in waste, you're getting paid to take the waste, and you produce a value-added commodity, that smooths out that risk profile quite a bit. And if you're taking waste in the US or Western Europe, a lot of that industry is regulated. The companies are large, they're creditworthy, And that really adds another revenue stream there that de-risks just thinking about, you invest in a mine, right? You have 10, 15 years lead time. The price is going to change over that time. If you're in a volatile jurisdiction, you have a whole nother host of issues. You have permitting issues, environmental issues, community pushback issues. Like the list of stakeholders goes on and on. Whereas if you have a waste to value commodity converter facility, if you have a good feedstock contract, a good offtake contract, a great construction partner and ground game partner, and a credible, well-researched plan to de-risk the technology and application, you've got a pretty good foundation of a business that can scale. And I think that as a pathway to get active in the sector is underappreciated, but increasingly getting focused and something that we're particularly focused on.
So let me try to reiterate this just then, is that the extraction pieces tend to be very difficult because you need like, it's just very difficult to build those things, right? So probably the big players will continue working on those because there's still a demand. But for a startup side of things, there's opportunities to come into the value chain where it comes to upcycling, and you can play off of the existing infrastructure that's there, and your lead time to like get things going is actually going to be lower. But you're also working with partners who have enough credibility that you can, through offtake agreements, et cetera, and maybe even partnerships, you can get the financing to be able to build these processing facilities to take care of the waste streams. Is that accurate?
Yeah, the point there is that, I mean, the contracts are relatively straightforward. You have two revenue streams, and you're dealing in 50, 100, 200, $300 million increments versus 1, 2, 3 billion increments with a longer 10 plus year lead time. And we could go from inception to our first facility in 3-4 years, in this kind of midstream process technology area, versus it might take us 12 years to be in production. If we went the traditional pathway, and $1 billion plus, right?
So one other thing I'm curious about is, are there specific, like, is the technology there to start doing a lot of this stuff locally, or does there have to be a lot of innovation broadly, like maybe even on the software side of improving the profitability of mining and processing industries?
Well, I think there's two things there. I think that if you look at the two dimensions, right, the innovation and outright reshoring, right, because there's a bit of both occurring right now, right, where there are new technologies being implemented to serve this initiative, and there's just outright reshoring that's happening right now as well. And I think that a lot of the technologies to extract, process, and refine these critical minerals are proven in places like China. The issue is that, like, in these jurisdictions, the calculus associated with the environmental externalities that are ancillary effects of what's being implemented today is treated, it's completely different in the West, right? You can't have this level of environmental degradation associated with the process and still maintain your government license to operate, or your regional social license to operate, looking to the community level, right? And so that is one particular thing of a lot of these outright. There are technologies that exist to do this at scale in China at present, right? Looking at more kind of the waste to value and the low environmental, two buckets, right? Waste to value, and then the low environmental negative externality pathways. Those are two separate things, right? Because on the waste to value side, there's increasingly a focus on the innovative pathways to extract these critical minerals from waste streams. Technology is improving, and there are winners that have emerged that have been able to do this successfully and have been able to prove that they can access real pools of capital to scale these businesses. On the low environmental externality side, there's two issues there. The first being, and this is really where the government is starting to focus, which is quite interesting, is the government's focus for a long time has been supply side intervention. And there's been a lot of calls to shift to demand side intervention. And so, thinking of, obviously, in the most basic terms, if you take technology that's at scale in China and you augment it with the equipment, software, whatever it may be, process technology that has perhaps an extra step or some kind of the redundancy mechanism that lowers the environmental impact, the cost is going to be higher, either from extra equipment capex, process capex, or just people. And so some of the issue there has been pathways have been developed, but the cost curve on which they compete relative to China is challenged, right? And so I think that what we're starting to see is at the intersection of the demand and return certainty and low environmental externality, demand side intervention being called for and that being taken seriously.
So, okay, then if we do start producing, let's say either in the US or through other countries that we, partner with, if we start producing cleaner minerals, whether that's through upcycling or kind of managing waste streams or brand new extraction, is it safe to expect that there will be a demand to buy this cleaner, probably more expensive mineral outside of the US? Like, if the DOE or the DOD is going to purchase from us, yes, but will other countries have an interest in purchasing these minerals, or is it just going to be like we got to buy what we make?
I mean, I think that so I understand. So to clarify, the question is there a preference for clean minerals
Yeah,
inside and outside the U.S.?
mainly if in the US, if we're making this stuff and it's costing us more to make it, the output is going to be probably more expensive. And so will other countries be willing to buy it versus buying, the cheaper stuff from China?
So it's quite interesting actually. If you look at the ecosystem ex-U.S., given the situation with the current administration, there is broadly a consumer preference for you sell a physical product to someone, and then you have a project finance capital market that you have to serve that finances all of this in a non-dilutive structure at scale. On the technology side, we see it going to companies that are extracting the value-added minerals from waste streams. We've seen a big trend if we're going to maintain AI leadership as a corollary to this, like we need all forms of energy that we can get to keep expanding that supply base, right?
Hey everybody, that is all for the free version of the episode. If you'd like to get the entire version of this episode, the full shebang, you can go over to our Substack and become a paid subscriber. You go to cleantechies.substack.com/subscribe and choose any paid subscription. Again, the paid subscription gets you access to all of our content we put out. If you are a paid subscriber at any tier, you will get access to all of it, and you'll get access to our group chat. So we have a lot of different people in there discussing kind of what they're working on from time to time. We discuss the topics of the episode. Occasionally, we ask people what they'd like to hear from upcoming guests, so you get a little bit of behind-the-scenes activity there. But really, we just really appreciate the financial support of the podcast to keep this thing going. It does take a lot of time. If you like it, we'd love to see your financial support from it. So again, get the rest of this episode by going over to cleantechies.substack.com/subscribe. And if you'd like, you can also cash in your one-time free trial to listen to the rest of this episode. So, all right, thank you so much for tuning in to Clean Techies, and until next time.